In this video, traders are going to look at why do people lose money investing in stocks when historically stocks have risen. Stay tuned. Hey guys, more and welcome to you. Alright, so these are my thoughts on why people seem to lose money investing in stocks when historically stocks have gone up. Now listen, there's a lot of people out there who are doing well investing in stocks. Obviously, by the time I'm doing this video, markets are all-time highs. Yes, not all stocks are all-time highs, but if you've got a broad portfolio, it's doing okay. But then there's cases of investors who seem to lose money trading stocks. Now that's trading, but what about investing? Investing is slightly different because we're looking for the growth of a company. And I'm going to be honest here, guys, I've never invested in big stocks for the long term. I've had some smaller cap stuff which has been brought to my attention. I've looked at it, I like the story behind it, I've thought it's worth a go. It's a high risk reward opportunity. Hold it for a few years. Works out, great. Doesn't work out, you get rid of it. I think that because I am trading actively these stocks and the markets day to day, that investing isn't really suited for me in this arena. However, I have observed other people investing, and I've seen a couple of things that I think that they're mistakes. So let me know what you think, if you agree or disagree, or ones that I've missed. So the first thing is they don't like drawdown. The investors have their portfolio of stocks. Let's say buy a couple of $100 worth of stock. It's going up, then it draws down. And let's say it draws down 25% from the high. All of a sudden that 200 grand values have dropped by 50 grand. They don't like that. They just can't handle drawdown, and it causes them to come out because they fear more drawdown. Instead of looking at the longer picture and saying, hey, this may be a short-term pullback, this is not going to affect the valuation of this company in the long term, which is why I'm in, they get pulled in because they see their assets declining, and that causes people to sell at lows. It just causes people to sell at lows. Another thing is they don't know when to sell. So the key, I think, is between, let's say, a small cap investment is that, whenever I've done something like that, I've always had a catalyst to sell it. So I've always said, right, I will buy this, but when they get this contract or this number or whatever it is, or get a patent or whatever the deal is, that's the time to sell it. It becomes a different investment then. And I think a lot of investors will invest in a company, but they don't really have a time to sell. And maybe they don't want to sell. Maybe they see, hey, I'm going to hold it. But then, there are times when stocks might just absolutely rocket because they've got deals and stuff. And then they might stagnate for the next few years purely because that was the juice. And now they're just kind of getting some traction and getting grips with things. And really that was the sweet spot to exit, selling the peak of the news. And then they end up drifting lower, and then they dump it when it's drifting lower because they expect it to go longer. So they don't really have a catalyst to sell. Now, I know that some people are investing, for longer term. They don't really want to be selling, but those are the ones that win. In my experience, the guys who are making money investing are the ones which have a portfolio of stocks, and they just don't care what happens to it. They're like, listen, I'm holding this forever. It's a portfolio of stocks. I'm investing in companies, some of the greatest companies in the world. I'm getting dividends as well. I don't care. I don't have it, and that's fine because that's their plan is do not ever sell it. Hold it until they die, for example. Whereas others, I think, again, have success when they say, right, when this gets to this, when I see this, I will sell it and take the money out and go into cash on this asset. And I think that's, rather being fueled by emotion, there's a plan, there's a strategy in there. Okay, so the third thing is they tend to buy high, sell low. So fueled by emotion, same running theme here, guys. They're buying high, thinking, oh, it's high. Oh, it's too high, I'm not going to chase it. A couple of months goes by, it goes even higher. Wow, this thing's going to the moon. I must buy it. They buy it, carries on running for a couple of months, and then all of a sudden, retraces back. And all it is just a mean reversion type thing. Stocks are going to shoot up, they're going to come down, just a natural ebb and flow of trend and backfill in the markets, whether we're looking at short-term chart or we're looking at a longer-term chart. It's just the way that the market is going. So they get fueled by emotions, they sell it low because they see a drawdown, they're chasing, and they're just doing the opposite of what we should be doing as investors, looking for bargains. You think about Warren Buffett. Warren Buffett, he wants to invest in many companies out there. He's openly said, I like this company, but he'll only do it at a price he considers value. And so he waits for his opportunity, accumulates cash, and if that opportunity doesn't come, he doesn't get involved in it. If the opportunity does come and he perceives it as value, then he puts his cash to work, then he sees what happens to it. So what about number 4? They become too focused on the dollar value. You don't need to be looking at the value of your portfolio every single day. Too many investors I know have a portfolio, a large portfolio, and they're constantly there in their account looking on the FT, whatever, working out how much money they've got. That is really a recipe for disaster, because what you end up doing is you end up judging the account based on the high watermark. So say it's done this over the month, let's say it's gone up by 25% over the month, just for argument's sake, and let's say it draws down to 20%, all you see is that drawdown. That's what it was, now it's down. You don't see, you're blinded to the fact that it is up 20%. And that's the trouble when you're watching it every day. It's like I say, alluded to earlier, the guys who, in my experience, who are doing well investing, the ones who just tuck it away, they don't look at it, they don't care. They get the dividend checks in and they have it and they leave it, and they don't assess it until a certain period of time or whatever it may be. Focusing on dollar value every day is a recipe for disaster. And the fifth thing is they get shiny object syndrome. So they have something, it's not moving, the stock's not moving this stock. You know, I'm seeing all these stocks elsewhere moving. You know, that tech company's rallying, you know, that oil company's rallying, this is rallying. Okay, I'm going to go into that, I'm going to come out of that and go into that. Then that stagnates, that goes, and they come back into this. And what they're doing is they're seeing something else moving, and then they think that's a better bet, so they put their money there. Now, under some conditions, of course, but when it becomes too frequent, all you're doing is chasing the next shiny object, and you're just going to end up chasing the market. You're never going to get deep value. You're never going to get, you know, that sweet spot that every investor wants, which is the real good kind of core position that then grows from the foundation that you've got. And the other thing is they churn too much. So similar thing, you know, buying and selling, trying to time the market too much. It's highs, they'll come out, I think they'll come back in, then it goes even higher, they're buying. And the history's shown and statistics show that there's only a few real solid months or solid years, if you look at a long period of time, that generate most of the returns. So if you're trying to time too much, you end up missing the real juice of the move. So the secret is, if there is a secret, in my opinion, again, you know, like I say, investing in those blue chip stocks long term isn't my approach, but from my observation of people who do, the successful ones are the ones who buy their portfolio, they'll add at certain times, maybe they'll do a dollar value averaging, maybe they'll put constant money in. If they don't, they won't be looking at it, they'll say, listen, this is the portfolio I've got, this is the way it is. I'm not going to do anything with it. I'm not meddling with it. This is not a trading vehicle. This is a longer term investment in some of the best companies that I think I've picked in the world. All right, guys, let me know your thoughts. Let me add a 7th or 8th in the comment section below. Why do you think investors seem to lose money when ultimately, you know, stocks do go up long term? Take care and keep the risk managed, whatever you're doing. Bye-bye.